If you enjoy in-depth stock breakdowns like this one, remember to hit the like button and subscribe. It really helps us grow the channel and ensures you don't miss out on any future investment analyses. Netflix is one of the most remarkable companies in the modern era of media and technology. What began as a DVD by mail service in the late 1990s has evolved into the global leader in streaming entertainment, a company that changed not only how we consume movies and television, but also how the entire industry operates. It is a story of constant reinvention, from disrupting Blockbuster to creating the first streaming platform, to producing its own award-winning content, to launching advertising-supported tiers, to expanding internationally with hits that transcend language and culture. Netflix has consistently stayed ahead of the curve, and in 2025, the company's financials and strategic initiatives proved that it continues to set the standard. The company's most recent quarterly results highlight this strength. Netflix reported over $9.6 billion in revenue in the second quarter of 2025, representing 17% year-over-year growth. That is a stunning number considering how mature the platform has become, and it was driven by both subscriber additions and price adjustments across different regions. The company's subscriber base reached more than 277 million, adding millions of new members in regions like Asia Pacific, Latin America, and Europe. What stood out was not just the growth in members, but the fact that average revenue per user also increased, showing that Netflix has been able to command higher prices while still delivering value to its subscribers. Profitability is another area where Netflix has differentiated itself. While many competitors in streaming are still struggling to find a path to profitability, Netflix posted an operating margin above 26% this past quarter. This is a dramatic improvement compared to earlier years when the company was spending heavily to scale its content library and expand globally. Free cash flow exceeded $2 billion in the quarter, and management guided toward more than $8 billion in annual free cash flow over the next few years. That level of profitability puts Netflix in a completely different category than Disney+, Warner Bros. Discovery's Max, or Apple TV+, which continue to operate at a loss or with very thin margins. One of the most important drivers behind these results has been Netflix's crackdown on password sharing. For years, sharing accounts was a cultural norm among Netflix users, but the company shifted its approach by requiring additional accounts or charging for extra users outside the household. Many feared this would alienate customers, but instead it has turned into a massive success. Millions of people who were previously watching for free have now converted into paying subscribers. This not only lifted subscriber growth, but also helped Netflix improve monetization in markets where growth had been slowing. At the same time, Netflix introduced an ad-supported plan that provides a lower-cost option for consumers while opening up a massive new revenue stream for the company. Advertising has always been one of the largest revenue pools in media, and Netflix now has the scale and engagement to compete directly with traditional TV networks and digital platforms like YouTube. With hundreds of millions of hours of watch time every day, Netflix offers advertisers a unique opportunity to reach highly engaged, targeted audiences. This business is still in its early stages, but it has the potential to generate billions in incremental revenue over the long term. Another strength is Netflix's global content strategy. Unlike its rivals, which often focus heavily on US-based content, Netflix has mastered the art of producing shows and movies that resonate both locally and globally. Squid Game from South Korea, Money Heist from Spain, and Dark from Germany are prime examples of non-English shows that became global phenomena. This approach allows Netflix to cater to regional tastes while also creating global franchises. And it helps reduce churn because subscribers see content that feels relevant to their culture. It also gives Netflix the ability to spend content dollars more efficiently by spreading production across multiple countries instead of relying solely on expensive Hollywood projects. When we look at competition, it is true that Disney, Amazon, Warner Bros. Discovery, and Apple have deep pockets and are investing aggressively in content. Disney Plus had a rapid subscriber ramp-up, and Amazon bundles Prime Video with its e-commerce subscription, making it a formidable competitor. However, the reality is that most of these companies are struggling with profitability. Disney's streaming division has lost billions of dollars, Warner Bros. Discovery has faced debt challenges, and Apple treats Apple TV Plus as more of a brand extension than a standalone business. Netflix, by contrast, is focused solely on streaming and has already proven it can scale the business profitably. This gives it a clear financial advantage to continue investing in content while still rewarding shareholders through buybacks and debt reduction. Management plays a key role in this story. Co-CEO Ted Sarandos oversees the creative side, while Greg Peters handles the operational and product side. This dual structure has been effective, balancing the need for great storytelling with the need for technological innovation and business execution. Reed Hastings, the legendary founder, remains on the board and continues to shape strategy at a high level. This leadership team has navigated multiple industry shifts and remains one of the most experienced groups in media. From a financial perspective, Netflix has a clean balance sheet with manageable debt and significant cash generation. The company has been using free cash flow to repurchase shares, which adds value to shareholders by reducing the float. Its long-term debt sits at around $13 billion, which is very reasonable given the company's cash flow power and market capitalization. This is in sharp contrast to Warner Bros. Discovery, which is burdened with more than $40 billion of debt. Now, let's talk valuation. Netflix trades at a forward price-to-earnings ratio in the mid-30s, which may seem expensive compared to traditional media companies. However, this premium is justified by its growth rate, profitability, and leadership position in streaming. If we look at valuation multiples relative to expected growth in revenue and earnings, Netflix appears reasonably valued for a long-term investor. Analysts have been steadily raising their price targets after the most recent earnings beat. In terms of scenario analysis, the base case assumes steady subscriber growth of 5 to 6% annually, mid-single-digit price increases, and continued advertising expansion. Under this scenario, Netflix could generate around $12 in earnings per share by 2026 and trade at a price target of around $1,500 within the next 12 to 18 months. The bull case assumes stronger international growth, faster adoption of the ad tier, and operating margins pushing toward 30%. In that case, Netflix could trade as high as $1,600. The bear case considers slowing subscriber growth, rising content costs, or intensifying competition, leading to margin pressure. Under that scenario, Netflix might trade closer to $1,000. These ranges provide investors with a realistic band of expectations while highlighting that the risk-reward is skewed positively. The investment thesis ultimately comes down to Netflix being a rare combination of growth and profitability in streaming. It has reached global scale, proven it can monetize effectively, diversified its revenue streams, and continues to innovate in both content and technology. While risks such as competition, regulation, or shifting consumer habits remain, the company's track record gives confidence that it can navigate these challenges. Based on all of these factors, Netflix is a buy for long-term investors. The company is positioned not only as the leader in streaming, but also as a cash-generating machine with multiple levers for growth. For investors seeking exposure to the global shift in entertainment consumption, Netflix remains one of the best opportunities in the market.